Gene, what was your takeaway then? How did you interpret their operating margin and their forecast?
Well, I had flashbacks to 2 years ago when we went through this, and so that's the first thing that came to my mind. The second thing is that the areas that they're investing in are the right areas. They're the same areas that have yielded this incredible return to growth that we've seen. Their unit growth has gone from 20% and has been steady at the high 20% over the last few quarters. And so the way I felt about it is, yes, it brings back some bad memories, but they do invest in the right areas. And I'm confident that these investments are going to yield continued impressive market share gains that should cause the stock to bounce back here.
The question that I asked an analyst a little bit earlier on, and when someone calls you and asks you how to value this company, given that Jeff Bezos doesn't seem to put any emphasis on the investor and all the focus, the obsession is on the customer, what do you tell them? What do you tell them to look for in the balance sheet?
Well, we look at the EBITDA earnings, and we're using a 14 times our 2018 EBITDA to get to that. And we think that's more or less in line with kind of broader internet. And so the pushback I get from investors is we have an impressive improvement in margins in 2018. And while that multiple 14 is relatively low and understandable, I think that they may take issue with our margin expansion.
And when you take a look at the other part of the story, which has to be, of course, their valuation. We talk a lot about PE when it comes to Apple. Take a look at this PE here. Based on 2018 estimates, Amazon trades at 46 times earnings. That's almost twice the current valuation of the NASDAQ 100. So make the case for why you should be paying up for that when you continue to have that operating margin story be a stress for investors.
Because you got to look past the next 1 or 2 or 3 quarters where the margins are going to need to be oppressed and look at what the potential of these margins can be. When you start to factor that in, it's much easier to get a multiple that's in the mid-teens like we were talking about. And so I think it comes down to, do you believe that this business has leverage to it? And that's the core question that investors debate. And in our case, we think that there is leverage. And if you assume that happens, the valuation is very reasonable.
Gene, what about their international expansion? They're going into India, they're trying to go into China. How important is that to their strategic vision?
It's important. They haven't done much outside the U.S. and Western Europe, haven't had much success in China. The one issue, yes, they have 22 fulfillment centers in India now, and they have about 150 in total. So this is an important part, but this is kind of a 10-year play. The reason is that even though India has a big population, the purchasing power is relatively small. It's about 1/5 that of an average person in China. And so this is the right thing for them to do. But as an investor who wants to invest in longer-term themes, I think India is something nice, but it's going to take probably 5+ years to really matter.
Gene, we've spent the bulk of this conversation talking about what the investors are focusing on today. Yesterday, Rich Greenfield over at BTIG was very keen to point out that the first 7 highlights in Amazon's quarterly release were devoted to media and to music. So let's talk about what the company is trying to talk about. The message they're trying to communicate there, how do they leverage that in a material way that it does actually mean something material to the investor?
Well, the way they do that is they're investing a lot in content, and so that they're saying is going to double their content investment. It's going to be right around $4 billion for next year, and that compares to Netflix at about $7 billion. The reason why that matters is that we think that progressively consumers are going to value the content offering when they think about Prime. And they can break that out and sell it separately, but which they do. But at the end of the day, the content piece is important because it reinforces Prime. When Prime's reinforced, consumers spend 4 times as much as a non-Prime user. And so that's the significance of this, of why they make a big deal out of content.
Gene, there was another tech company that reported yesterday. It was called Alphabet. Because of Google. And there's one thing that particularly jumped out. I mean, they had a terrific announcement, I think, from their point of view. But one number that jumped out is they went up by 42% in the number of ads clicked. Largely, it appears, because of YouTube. I mean, is the sky the limit here? I mean, just when you think they've gotten pretty much all the market they could get, this is a remarkable number.
That's exactly right. I mean, that's well put, because it's hard to imagine this $74 billion advertising company continues to grow at the pace that it does. It was 23% on an FX adjusted basis, similar to the growth rate that was in the June quarter. You're right that YouTube is one of the driving factors behind that, but core search tends to be very stable too. And I think as far as is the sky the limit, there are still major areas that we use, Google products that we use like Maps that aren't monetized today, that they're going to start to monetize. Don't be worried about a bunch of ads coming up when you do a Google Map search, but they will be more aggressive at doing that. So the sky is the limit when you start to think about these other pockets that they can start to make money from that they historically haven't.